How do airlines use hedging to stabilize fuel costs? Imagine flying across the world and knowing exactly what your airline will pay for fuel months in advance. That's the power of hedging. Airlines face huge costs from jet fuel, which can change rapidly due to crude oil prices, political events, and refinery issues. These price swings can make planning and budgeting tough. To manage this, airlines use a financial strategy called hedging. Hedging involves signing contracts that lock in fuel prices or give financial compensation if prices go up. This helps airlines avoid surprises that could eat into profits. The main tools they use are derivatives like futures, forwards, swaps, and options. Futures and forwards are agreements to buy a set amount of fuel at a fixed price on a specific future date. Swaps are contracts where airlines exchange variable fuel prices for fixed prices, effectively locking in costs. Options give airlines the right, but not the obligation, to buy or sell fuel at a certain price, giving them flexibility. For example, an airline might buy a swap contract to fix the price of jet fuel for a year. If market prices rise above that fixed price, the airline benefits because it pays less than the current market. If prices fall, the airline pays more than the market but gains predictable costs. Usually, airlines hedge only part of their expected fuel needs to balance risk and potential savings. They also stagger contracts over different times and volumes to spread out their exposure. Strategically, hedging helps airlines keep their budgets stable, making it easier to plan for future expenses. Some airlines, like Southwest Airlines, hedge large portions of their fuel needs, which can save them money during periods of rising fuel prices. They often combine hedging with efforts to improve fuel efficiency, like using more aerodynamic aircraft or better flight routes. Hedging does come with costs, such as premiums for options or potential losses if fuel prices move in a favorable direction. Airlines weigh these costs against the benefits of cost certainty. From an investment point of view, airline hedging activity influences fuel derivative markets and can impact fuel prices overall. In short, airlines use hedging to lock in fuel costs or manage the risk of price swings. This approach helps them keep expenses predictable despite the ups and downs of the fuel market. It's a smart way to stay financially stable and keep flying smoothly, no matter what happens to fuel prices.